You have been paying into Social Security your entire working life. Every single paycheck before you ever saw a dollar of it, 6.2% was taken out. Your employer matched that with another 6.2%. Year after year, decade after decade, that money went into the system under a very specific promise. The promise was simple. You pay in now, and when the time comes, whether that is retirement, disability, or a family emergency, the system will be there for you. Someone will pick up the phone, someone will be at the office, someone will make sure you get every dollar you are legally entitled to without confusion, without delay, and without you having to fight for what is already yours. That promise is not being kept. And the consequences of that broken promise are playing out every single day across the country in the form of missed benefits, incorrect payments, unanswered calls, and families who never knew what they were entitled to until it was too late to collect it. Today, we are going to talk about exactly what is going wrong inside the Social Security system, why it is happening, how the funding structure actually works, and what the real timeline looks like for the trust fund, what overpayments are, and why they happen more than most people realize, and several specific benefit situations that catch people completely off guard, including divorced spouse benefits, grandparent benefits, disability closed periods, and how retirement payments are scheduled. This is information the Social Security Administration should be explaining clearly to every single person who has ever paid into the system. Since they are not doing that job, let us do it here. Start with the foundation of what Social Security was supposed to be. Since 1935, American workers have paid FICA taxes on every paycheck they earned. That 6.2% from your wages, matched by your employer, was not a voluntary contribution or a charitable donation. It was a legal obligation tied to a specific arrangement with the federal government. You pay in throughout your working years, and the system provides financial security when you need it most, at retirement, in the event of disability, and for your surviving family members if you pass away. A small portion of the money collected, less than 1%, was specifically designated to fund the administrative infrastructure needed to actually deliver those benefits. Phone lines staffed by knowledgeable people. Local offices with trained employees who could sit across from a widow, a disabled worker, or a confused retiree and walk them through exactly what they were entitled to and exactly how to get it. That administrative commitment was part of the deal, and that is the part that has collapsed. Social Security staffing is currently at a 50-year low. Let that register for a moment. While the number of Americans dependent on Social Security has grown dramatically, with roughly 12,000 baby boomers turning 65 every single day, the workforce responsible for serving those Americans has been systematically reduced for decades. This is not an accident, and it is not a recent development. It predates any single administration or political figure. What it represents is a sustained, multi-decade failure by Congress to adequately fund the administrative operations of a program that serves tens of millions of people. Politicians across generations have consistently underfunded Social Security's operational budget while simultaneously blocking any meaningful legislative reform to address the program's long-term financial structure. The result is a system where people who have paid in for 30 or 40 years cannot get a human being on the phone, cannot get accurate answers when they do reach someone, and cannot trust that their benefit amount has been calculated correctly. When people lose months of benefits or miss filing windows or never learn about benefit types they were eligible for, that is not an abstraction. That is real money that real families needed and never received. The compounding irony is that the people who most need help navigating the system, older Americans, people with disabilities, surviving spouses in grief, people with limited financial literacy, are the exact people least equipped to fight through hours-long hold times, confusing online portals, and overburdened local offices to get the answers they need. The administrative collapse of Social Security does not fall equally on everyone. It falls hardest on the most vulnerable people the program was specifically designed to protect. Now, let us talk about how the money actually flows through the Social Security system, because there is an enormous amount of misinformation about this, and understanding it correctly is essential to understanding what the real financial challenge ahead looks like. Social Security operates primarily as a pay-as-you-go system. That means the payroll taxes collected from people currently working are used to pay the benefits of people currently receiving Social Security. Approximately 91% of every Social Security benefit check comes directly from current payroll tax contributions. The remaining 9%, and this percentage is gradually increasing each year as the baby boomer generation continues moving into retirement, comes from the Social Security Trust Fund. The trust fund is not a myth, and it was not stolen. It is real money, accumulated over decades when payroll tax collections exceeded benefit payments. There is currently over $2 trillion in the trust fund. But here is the critical reality that every American needs to understand clearly. That trust fund is being drawn down. Every year, as more baby boomers retire and the ratio of workers to beneficiaries shifts, more money comes out of the trust fund than goes in. At the current rate of drawdown, the trust fund has approximately 81 payments remaining before it is exhausted. When the trust fund reaches zero, Social Security will not be able to pay full benefits from payroll taxes alone. The projected shortfall at that point is approximately 23%. That means without congressional action, benefits would need to be reduced by roughly 23% across the board. This is not a prediction or a political talking point. It is the actuarial projection based on current contribution rates, current benefit levels, and current demographic trends. The solution exists and has been understood by policy analysts for decades. Congress simply has not acted. That inaction, sustained across administrations of both parties for over 40 years, is the actual source of Social Security's financial vulnerability. Against that backdrop, let us get into the specific benefit situations that generate the most confusion and the most preventable loss of money for real families. Each of the situations described below represents a category of benefits that exists in law, that Americans have earned the right to receive, and that goes unclaimed every year in enormous volume simply because the Social Security Administration is not adequately explaining it to the people it serves. Understanding these rules is not a luxury. For many families, it is the difference between financial stability and financial crisis in retirement or during a period of disability or loss. Divorced spouse benefits are among the most misunderstood and most underutilized benefits in the entire Social Security system. Millions of Americans who were married for a significant portion of their adult lives, contributed to the household economically, and then went through a divorce have no idea that they may be entitled to benefits based on their former spouse's earnings record. Here is how it works. If you were married to someone for at least 10 years and you are currently unmarried, you may be eligible to receive a benefit based on your ex-spouse's Social Security record. The key condition is that your own full retirement benefit must be less than half of your ex-spouse's full retirement benefit. If that condition is met, Social Security will increase your payment to bring it up to that 50% level. You do not need your ex-spouse's permission. You do not need them to be currently receiving benefits, though they do need to be at least 62 years old and eligible. Your ex-spouse's benefit is not reduced in any way by your claim. This benefit exists completely independently and is funded by the system as a whole. The minimum age to begin receiving divorced spouse benefits is 62, and you must be currently receiving your own Social Security retirement benefit to initiate the claim. If you never paid enough into Social Security on your own to qualify for retirement benefits, you may still be eligible for divorced spouse benefits independently. The critical mistake people make is assuming that because they did not pay into Social Security themselves, they are simply not entitled to anything. That assumption is wrong, and it has cost people real money. If you were in a marriage that lasted 10 years or more and that marriage ended in divorce, that conversation with Social Security is worth having. Survivor benefits for divorced spouses operate under a slightly different set of rules. If your ex-spouse passed away, the marriage duration requirement drops to 9 months rather than 10 years, provided the marriage lasted at least 9 months before death. Widows and widowers, including those who were divorced from the deceased, may be entitled to survivor benefits that represent a significant portion of what their former spouse earned over a lifetime of work. Many surviving divorced spouses never file for these benefits because they assume the divorce severed any financial connection to their former spouse's Social Security record. That assumption is incorrect, and it costs people real money every year. If you were married for at least 9 months and your former spouse has passed away, a conversation with the Social Security Administration about survivor benefit eligibility is worth having regardless of how long ago the marriage ended. The situation involving grandparents raising grandchildren is another area where substantial benefits go unclaimed because families simply do not know the rules. Social Security does provide benefits for grandchildren in certain specific circumstances, but the eligibility requirements are precise, and they are not automatically triggered. For a grandchild to receive benefits on a grandparent's Social Security record, several conditions must be met simultaneously. The grandparent must be currently receiving Social Security retirement or disability benefits. Both of the child's parents must be either deceased or disabled, meaning both parents, not just one. The grandparent must be providing at least half of the child's financial support, and either a formal adoption must have occurred or the circumstances of parental death or disability must be documented and verifiable. If all of those conditions are present, the grandchild can receive a monthly benefit based on the grandparent's earnings record. For grandparents serving as representative payees for grandchildren already receiving their own Social Security benefits, there is an important planning consideration around continuity. The Social Security Administration has an advanced designation process that allows a representative payee to name a successor in advance. If no advance designation has been made and something prevents the current representative payee from continuing, a family member or other trusted individual can go to the local Social Security office and apply to become the new representative payee. The process is designed to be straightforward and to ensure continuity of benefits for vulnerable individuals. Disability benefits involve one of the most misunderstood provisions in the entire Social Security system, which is the concept of a closed period of disability. This situation arises most commonly at the administrative law judge level, the third stage of the Social Security disability appeals process. Because that process can take years from initial application to final decision, it is entirely possible for someone to file for disability, have their claim denied at earlier levels, wait for a hearing before a judge, and by the time that hearing occurs, have partially or fully recovered from the original disabling condition. In that circumstance, the administrative law judge can approve benefits for a closed period, meaning the specific window of time during which the applicant was demonstrably unable to work. For a closed period approval to apply, the disability must have lasted at least 12 months, which is Social Security's definition of a qualifying long-term disability. The judge reviews the medical record, identifies the onset date and the date of medical improvement or return to work, and authorizes payment for that defined period. The retroactive payment for a closed period can be a meaningful lump sum for someone who was genuinely disabled during that time, but received nothing while waiting for the process to conclude. Understanding how Social Security retirement payments are scheduled is something every person approaching retirement needs to know before they file. Social Security always pays benefits 1 month in arrears. The payment you receive in any given month represents the benefit you earned the previous month. If your first month of eligibility is June, your first payment will not arrive until July. Additionally, the specific Wednesday of the month on which your payment arrives depends on your birth date. If you were born on the 1st through the 10th of the month, your payment arrives on the second Wednesday. If you were born on the 11th through the 20th, your payment arrives on the third Wednesday. If you were born on the 21st through the end of the month, your payment arrives on the fourth Wednesday. Knowing this schedule in advance allows you to plan your household finances appropriately for the transition into retirement. Overpayments create serious financial stress for beneficiaries every year. The most common source involves the earnings limit for people collecting Social Security before reaching full retirement age. In 2025, that limit is $24,480. For every $2 earned above that limit, Social Security withholds $1 of benefits. Because Social Security learns about earnings through the following year's tax return rather than in real time, overpayments are often discovered a year or more after they occurred. If you receive an overpayment notice, you have the right to appeal the determination, request a waiver based on financial hardship, or arrange an interest-free repayment plan. The people who get every dollar they are owed from Social Security are not the ones with the best luck or the best connections. They are the ones who understood the system well enough to ask the right questions at the right time. The system that was supposed to make that easy is understaffed, underfunded, and overwhelmed, which is exactly why knowing these rules yourself, before you need them, is the most financially protective thing you can do. This is Social Security Vault.